Good afternoon. Welcome to the first webcast, the first financial forum. We're very glad you're here, delighted you registered and are participating with us today. We'll be hosting these webcasts regularly, covering important topics pertaining to the banking and financial industry. Certainly, we have a lot to discuss today, and I have two very special gentlemen with me. Both of them are experts in the banking industry and regulators that have gone through probably more collectively than anyone I personally know. I'm Bliss Morris, founder and CEO of First Financial Network. I'll give you just a brief description of my background professionally. So many years ago, I went to work for the FDIC here in Oklahoma City, very shortly after Penn Square Bank had failed. And I was involved in the process in the original days when the FDIC began to try to figure out what investors and banks, other funds that might be interested in purchasing loans that came in from failed institutions. And so here I sit today, 33 years later, after founding First Financial Network. We work with the FDIC, many banks around the U.S., money center banks, regional banks, and community banks. And more recently, I guess it was a couple of years ago, I re-engaged with Mitchell, and then Mitchell reintroduced me to Bill Isaac. Bill didn't remember meeting me the first time, which he wouldn't, but he was chairman of the FDIC in 1985 when a very interesting bank failed in Chinatown, Golden Pacific Bank, and I was there as I think a lowly clerk typist with the FDIC on the closing team. So it was great to meet Bill a couple of years ago again. So Bill is past chairman of the FDIC. He was the youngest chairman, I believe, to ever serve at the helm of the FDIC at 35 years old. He went on and was chairman of Fifth Third Bank and there several years, and he's done many other successful things and started different companies. And presently, Bill is the chairman of Secure Isaac Group. Secure is a global advisory firm serving the financial services industry. He really has an unparalleled career in the financial industry and public service, spanning over 50 years. He served as chairman, as I mentioned before, of the FDIC from 1978 through 1985. That was a significant banking and thrift crisis of the 80s, when over 3,000 banks and thrifts failed. Today, Bill is a leading commentator and consultant to financial institutions and many different governments. He is a published author. Bill has published a book called Senseless Panic, A Washington-Filled America. And the foreword in that book was penned by, I know, a very good friend of Bill's, Paul Volcker, and we're going to talk about Paul and some of the things that were going on during the banking crises of the 80s. And also there was some commentary written about Bill's book by the former Wells Fargo CEO and very smart banker, Dick. And Bill, tell me again how to say his last name. I don't want to mess that up.
Kovacevic.
Thank you. Thank you. And I also want to introduce Mitchell Glassman to you. Mitchell was also at the FDIC when I was one of those clerk typists here in Oklahoma City. And Mitchell's career there spanned 40 years. He was the former director of the FDIC's Division of Resolutions and Receiverships for a number of years. Mitchell currently is serving as a senior executive advisor to Bill's company, Secure Isaac Group, and is a very integral part of the executive team there. He joined Deloitte after leaving the FDIC and was there for a number of years as well. When Mitchell was at the FDIC, he kept the board advised and the chairman on all important receivership matters and anything that required high-level decisions. So as you can well imagine, during the global financial crisis, starting in 2008, Mitchell was an extremely integral part of what was going on at the FDIC. So with that, let's talk a little bit about, what has been happening. I mean, everybody's been glued to the news, I'm sure. And Bill, you've been hosted on, a variety of newscasts and podcasts and other shows, and will continue to be. But the recent bank failures of Silicon Valley Bank and Signature, and then of course the self-liquidating Silvergate Bank has led us into a number of events that are in motion, with our regulatory agencies, bank depositors, and markets. And I think, I was thinking back on the 80s, Bill, in your experience when you were at the helm of the FDIC, and there are some similar scenarios here that existed in the late 70s and early 80s when Paul Volcker, he was there serving as chairman of the Federal Reserve, and you, of course, were chairman of the FDIC. Mr. Volcker was challenged with fighting inflation and raising interest rates, while you were leading the FDIC through one of its most tumultuous times, for sure. So talk to us a bit and share with us, Bill, what are the similarities with the issues that we're facing today and what you were facing with the banking system in the 80s?
Well, thank you, Bliss, and I'm happy to be here with you and with my good friend Mitchell. This will be fun, and I think we probably have a lot of friends in the audience. I can't see everybody or anybody basically, but I'm really happy to be here with everybody. The 80s were a very turbulent time, and the major similarities are we went through a lot of turbulence in the 60s and the 70s with riots on college campuses over the Vietnam War and riots in the cities over civil rights freedoms, trying to get more civil rights freedoms in the country and protections. So it was a very tumultuous time. We were troubled. I was in college in the 60s, and so I lived through all that, and it was amazing. And anyway, we got through it, sort of. It was difficult. A lot, fires in the streets. People were being killed. There were students shot on college campuses by the National Guard, and it was a tough time. It was a tumultuous time in the U.S. And we are in those kinds of times again, what I just described. This is a tumultuous time. There's a lot of dissension. There's a lot of disagreements and arguments and fires and riots and things like that. So it's similar in the social sense. And I'm not saying that that's a good thing. That they were both bad things, but that happens every now and again in a country. I mean, we went through a civil war, and so that kind of thing happens every now and again. And we're in very similar periods politically right now. We're badly divided. We argue about everything. Yes. We think the other person's always wrong, and so forth. So that's similar. The other thing that's similar is we've gone through a period of very high inflation, and due to, I think, terribly flawed monetary policies and horrible, reckless fiscal policies. We're spending way too much money. We did it back then, and we're doing it again today. After Paul Volcker and the Fed and the FDIC and the whole public had to deal and sacrifice to deal with inflation and get that out of our country and out of our economic system so we could all live better, particularly the underprivileged. The people who suffer most when you're in an inflationary period are the people who have less. People who have a lot of money, they'll get along. Don't worry about them. But the people who really get hurt when we're in an inflationary period are the less fortunate. And why politicians think it's okay to have inflation, why they want to have great big deficit spending and way too loose monetary policy, which devalues the dollar. I don't know. I don't know how they justify that when they go to bed at night. I really don't. Mm-hmm. But anyway, we're there again. So the periods are very similar in a social sense, in a political sense, and in an economic sense. And the problems are going to be dealt with in the financial system are also similar. I mean, we just had the Silicon Valley Bank fail. Why? Because it invested very long at low rates. They didn't take credit risk. They bought safe stuff, but it was very long. It didn't have any liquidity to it, and it was fixed rate. at a time when the Fed was going to be increasing interest rates. Anybody could see that had to happen. And they did it anyway. And the board and management made serious mistakes. They should have been fired. They were. Their bank should have failed. It did. And we'll probably have more. Because we did have more. We had Signature Bank, and we have the Silvergate Bank. But I'm saying that they can't be the only three banks in the country that made that kind of mistake. Why the regulators let that happen, I don't know. It was pretty obvious what they did was wrong. They didn't even have a chief risk officer for the last year of their existence. So very similar period, very similar mistakes. Unfortunately, we didn't learn lessons, and now we got to fix them. And I'm confident we will. We will get on top of this and we'll fix it. What I hope we don't do is pass a bunch of silly, excessive laws and regulations. We do that every time we have a problem and they don't work. What we need is better bank supervision. Supervision, not regulation. Supervision needs to be better. We've got all the laws and regulations we need. There's no reason why the regulators could not have stopped Silicon Valley Bank from doing everything it was doing. It tripled in size in the last 3 years of its existence. What regulator would think that was wise? What bank director would think that was wise? Right. That's how First Pennsylvania failed in 1979. And yet we let it happen again. So I don't think you can pass all the laws you want to pass. You're not going to stop people from doing dumb things. The way you do that is hiring really good boards of directors, having really good management in place, having super regulators overseeing it, and coming down on banks when they start going awry. We know what they should be doing. They know what they should be doing. And when they're not doing it right, get on them, get rid of them. Anyway, those I didn't mean to preach, but that's my assessment of the two periods, and they are almost identical, unfortunately.
Yeah, absolutely. I mean, I was looking back in history a bit and reading through it, and it's almost alarming how many similarities there are. Let me ask you another question, Bill. So similar to SVB, as we all know, there are a number of banking institutions that are holding for investment safe securities that obviously have some very large losses associated with them. Of course, they don't have to mark them to market unless they have to sell them. Does that concern you?
Well, does what concern me? Does they have large portfolios of fixed rate assets?
Yes.
Yeah. I mean, it's critical that banks manage their balance sheet properly. And they know that. They don't need to learn that lesson 1,000 times. They already know it. They've seen it. And Silicon Valley Bank, why they chose to do exactly what First Pennsylvania Bank did in 1979, I can't comprehend. It was First Pennsylvania was a grand old bank that had the #1 bank charter for national banks. It was the first national bank in the country, first #1 charter. And they went out and did these dumb things, reckless. And now Silicon Valley Bank says, oh, there's a bank in 1979 that did this. Let's go see what we can do with it. I mean, it doesn't make sense. You give it a little bit of thought, a lot of thought maybe, before you take these actions. Hire some experts if you don't have them in-house. But get good management and get good directors in place, and the regulators need to be on top of it. When Silicon Valley Bank tripled in size,
yes,
from 60 billion or so to over 200 billion in 3 years, I don't understand why you didn't call out the fire department,
right? If
you're the regulators, and have all the sirens going and just descend on the place. Yeah. I really don't understand how that didn't happen.
Yes, it was stunning. As that bank was unraveling, and right before the FDIC, closed the bank, I was looking through their fourth quarter 2022 financials, and I was stunned. It was so obvious, it'd be obvious to anybody. I mean, you wouldn't have to be obviously even a bank regulator to recognize huge problems within that institution.
And Bliss, I didn't wasn't close to that bank. I had heard of it,
Mhm,
and I always had thought of it as a good bank,
mhm.
that they were investing in Silicon Valley companies and, new startups and so forth. And it was a specialized sort of bank, and it seemed to have a really good reputation. I wasn't paying attention to it. You could have knocked me over with a feather when you told me it was $200 billion.
Yeah.
I thought it was a 50 or $60 billion bank, which is what it should have been
Mhm.
at most. Why do they need to be $200 billion? I don't know.
Yeah. I had no idea that institution was that size. So, and I think this is interesting because, we've had a couple of things that have occurred, in the last several days, and based on the most recent press releases from the FDIC, they've sold the remaining assets from Signature Bank, of course, and Silicon Valley Bank. But what's left behind is a very large number of assets. Collectively, between the two institutions, there's about 150 billion in residual assets, that would be securities and loans and, any other bank assets that the acquiring institutions did not take on. And, to put this in perspective, I was thinking about these two particular banks. And from 2008 through 2013, almost 500 banks failed, which of course, Mitchell, you were very involved in that entire process, at a cost of approximately 73 billion to the Deposit Insurance Fund at the FDIC. And yet we've got these two large banks, and FDIC is now estimating that the cost to the Deposit Insurance Fund from the most recent two failures at about 22.5 billion. So, Mitchell, I think it would be, really important to the audience, that has joined us today, for you to share about how the FDIC typically tries to monetize these assets and minimize that cost to the Deposit Insurance Fund.
Thank you. And I appreciate being invited to this webinar. Let me go back, Bliss, because I think what a lot of people who have first started, watching and seeing the news, because obviously it's been constant really for the past 2 weeks, is just the understanding of what the FDIC's role is when a bank fails. And there's two different roles. One is the deposit insurer. And we heard a lot about the FDIC, initially transferring these assets to a deposit insurance national bank, which were insured deposits. And then eventually all deposits got taken care of. So they wear two hats. One is the deposit insurer, but the other is also to act as receiver. And the receiver is something that is very special to the FDIC. It's something very unique, but also very powerful in having that ability to be able to take on the complete operation of the bank. In other words, whatever the bank had as its assets or liabilities gets passed to the receiver. So it's always FDIC as receiver of, in this case, Silicon Valley Bank or Signature Bank. And from that receivership are the transactions that can transpire out of it. So that's where the transfer to the DMV, eventually to the bridge, occurs. But the benefit of having the receivership is that anything that is not sold at the initial resolution, in other words, the FDIC tried very hard to try to pass as many of the deposits and as many of the assets as possible, sometimes with loss share, with different types of provisions, with the idea that it's trying to minimize the amount of assets that remain in the receivership. But the receivership is just not for assets. It's also there to process claims, to establish who gets receiver certificates. They have a responsibility of doing the accounting, the bookkeeping, the reporting, the deal with the customers, to service the assets. So whatever shoes the bank was in for those assets and for those claimants, they remain, and the FDIC takes on responsibility for that. And staff, professional staff from FDIC is there, but they also utilize the former bank employees, and if need be, they also have access to contractors and subject matter experts to be able to manage the portfolios and to manage the other affairs. The other most important thing they will do is also the investigation, which is again what the administration wants, what we heard from Congress, but FDIC will also investigate those who may have created losses or done things that were inappropriate, so that if there are claims that can be filed against those individuals or against policies, the FDIC will be able to do that. So the receivership has a broad base of responsibilities. And under fiducia, there were even some fence posts put up as to what the operation is supposed to be, how they're supposed to operate. And one of it is that they are to maximize the net present value returned to the FDIC. In other words, to make sure that they're getting the best possible transaction and to minimize those losses to the deposit insurance fund. So, so the FDIC as receiver has to use good business judgment and make sure that what they're doing. They want competition in the sale of these assets. They want it to be competitive, but they want it fair and equitable. So there cannot be any discrimination for sex or race or whatever. Everybody gets a fair approach to be able to come in and buy assets, to negotiate, to do what they have to do. And obviously, one of the things that was important in fiducia is that any chance that if the FDIC has assets that are related to affordable housing, we want to maximize and maintain that as much as possible. So that is what the receiverships is all about. Getting to your question, if indeed the FDIC does have assets remaining, which a lot of times it does, you're pointing out there, there was 150 billion, depending on what the assets are, there's usually three buckets that those assets get placed in. One is securities. The other are the assets themselves, the loans, and then if they have ORE, real estate owned, or foreclosed properties. So those are kind of the three buckets that are maintained. The FDIC will continue to service the loans in order to maintain value, but it's always in the best interest of the receivership and the FDIC to try to move those assets from the FDIC as receivers' hands to the public or to investors. Not only because you have loss of value, but the economy changes. The fact is that it's very costly to maintain the receivership. So they have some well-stated protocols. We've had the FDIC's had a lot of experience, over the past 70 plus years of figuring out what are some of the best approaches to monetize these assets. In particular, when you're dealing with the sale of securities. Again, a lot of these are private label. They may be, bonds of a particular community. Usually, a lot of them are illiquid, or that they're so specialized in nature. So the FDIC tries to sell those a lot of times internally, sometimes with the help of a financial advisor, tries to sell those in the marketplace where they can best get the best value. We have on occasion, the FDIC has put these securities together for some securitizations, and that's also been successful. What's going to happen with the securities that are now in these two receiverships? It's good to see what's going to happen. They could hold them there, wait until they mature. It's possible they can put them out on the market. It's possible the FDIC could hold them and provide cash to the receiver. Because one of the things is receivership, you want to try to terminate it as quickly as possible because it pays dividends, and FDIC is one of the primary creditors. When it gets to the sale of loans, again, there's also various options. One is the bulk sale of loans. Again, I think this is something the First Financial Network has been deeply involved with, taking loans in bulk. One of the things that you have to do when you sell loans is to make sure that you can give full disclosure as to what those loans are, whether they're small consumer loans all the way up to the very large commercial loans. So to be able to do a cleanup of the files, to digitize them, to put them in a place where potential investors can come in and competitively bid is going to be something that the FDIC will probably be doing, not only at these two failures, but if there's any other failures in the future, particularly if there's volume that starts to enter the system very similar to what happened during the last crisis. What's also I think pretty cool is the fact the FDIC has a very sophisticated website to not only place these assets, so that for those in the audience today who are listening, that if you are potential investors and no investors, sign up. This is a good time for be a buyer. It's a good time to actually be part of the solution and help the FDIC. And then we can securitize them. And there's different vehicles of securitization that can go on, whether they're similar assets, they may be different mixes of assets. But the FDIC was very, very successful in securitizing assets, which reached a broader audience, but also gained a lot of value as we go. We also use limited liability companies, where we passed the asset and then had different tranches that were sold off. Again, that brought a different layer of buyers. It was done when selling in the marketplace was a little bit more difficult. But again, it was the way to monetize value, to meet market demand, and to do it in a sophisticated way that brought the best value to the FDIC. So the FDIC is only 1 degree separation between what the FDIC does and frankly what Wall Street does as far as how they move assets. And then the last category is ORE. These could be foreclosed homes, they may be commercial buildings. So a lot of brokers are brought in because if they know the marketplace, they're in the local market. And again, depending on what happens, if it doesn't sell through brokers, the FDIC will go to auction. And a lot of times I remember we always try to mix the bitter with the sweet, try to put some, good properties with some of the marginal properties to bring in more buyers. And again, the FDIC has been very successful in moving that product.
You make so many good points, Mitchell, and especially as it relates to the FDIC, usually so many different avenues to resolve, any sort of a failed bank situation. And to your point about opportunity, I know that we at First Financial get a lot of calls from smaller banks that might not be able to participate on the franchise side of FDIC in a bidding process for the bank. Because they're too small. But to your point, they're performing loans that come out of these failed institutions and non-performing loans. But banks can participate and investors can as well as a part of the resolution to that process. Were you surprised? I wasn't, but I'm curious what your thoughts are. Were you surprised about the loss share agreement that was entered into on Signature Bank?
No, not at all. I think, the FDIC has to do the least cost, and it was a systemic its situation. I think based on what they knew of the situation and what that marketplace and the value of those assets, I think that makes good sense. We've always found that moving the borrower and the asset to the bank where they can continue on with their banking needs. They may be able to refinance. They may be able to find ways to actually make those assets even worth more. It also minimizes disruption to the marketplace, which affects all the other banks in that area. So I think it was something they had in their back pocket, in their tool chest, and I think they utilized it properly.
Absolutely.
And let me point out one other thing about folks who want to buy assets, particularly banks or investors. One of the common things I hear, it's not only are we going to get a good value, but we're establishing a new customer. We're able to bring in customers that we wouldn't be able to get through our own local marketing and what have you. So I've talked to a lot of bankers over the years that really were very happy with not only dealing with the FDIC, but also when they came to the market to buy assets, and the fact that they have established relationships that are more profitable going forward.
Now, I agree, because I think we all know that's usually a win-win for the borrower and the acquiring bank in those type of situations. And the FDIC is well known for running an extremely transparent process and being focused on maximizing value, which is so critical to the Deposit Insurance Fund. I'm thinking about all the economic issues that are brewing out there, right? There's a lot of stress being created in the banking system. We've got continued rate hikes, deposits being transferred into larger banks like we've seen over the past several weeks. or invested in, higher interest bearing investments, residual balance sheet risk for securities. And we know there's also a COVID hangover. My gosh, I mean, our government threw a lot of money at a huge issue. Not to say anything about, of course, the SBA's ginormous portfolio of idle loans. So there's a lot out there, and we're seeing some falling property values. I was noticing an article this morning. Property values are, going down in residential homes on the West Coast, are going up on the East Coast. Yet we have a lot of concern over, office and how that's going to look, in the future, inflation and recession. Banks right now alone are holding about 2.8 trillion of all the commercial real estate debt in our country. And that's a very, very big number. I mean, when you think about it, we hear a lot about, of course, commercial mortgage-backed securities, and they're only holding 11%. So our banks are the ones that are the super lenders here. Bill, with all of your tremendous experience, I mean, what should banks be doing now to hedge against these liquidity, capital, and credit risks?
Wow, could you come up with a bigger question?
You're a big guy. I know you got the answer to this one.
I was just listening to Mitchell and enjoying his remarks. I like Mitchell a lot. He was at the FDIC when I arrived. I think we were there about 4 years before I came, Mitchell.
Yes.
Yeah. So he was a young guy, younger than I, and I was really young. I was 34. But he was younger than I, and he was at the FDIC, and he was so obviously talented and smart. And I have followed his career very closely over the last 40 or however long it's been. And he's an amazing guy. You see the smile on his face. He almost always has it. He's very kind to people, but he works like crazy. He's smart, knows what he's doing, and that's the kind of people that exist at the FDIC. And I know FDIC gets banged on a lot by people, but it really is a great organization with very talented people, and they really care about what they do, and which made my experience there really good. Now, what did you ask me? I don't remember. How are we dealing with this climate?
What do you think the banks should be doing now? I mean, to really be prepared.
Well, it's hard to answer that question in general because every bank is different.
Sure.
And has different issues. I would just say that I believe in this country. We will come back whenever we're in problem. We've been in a lot of problems. We've been in civil wars, revolutionary wars, World War I, World War II, huge depression, the 80s, whatever we want to call it. I'd say it was pretty close to a depression. But we really have a lot of resilience as a country. We have great people who came from everywhere in the world. So we have a lot of different cultures, and we work really hard for the most part. So, and we're a democracy, which is a great strength. I hope that I'm going to preach a little bit because I look back on this and I really have some strong views. The free enterprise system that we have in this country is the strongest economic system the world has ever seen. We are a very powerful machine in this country, and let's not destroy it. Congress, don't throw any more regulations and laws at this banking industry. You've done more than enough. We ought to be taking some of the laws off, and we ought to be making more sense out of the other ones that are on. We've got a really confusing mumble jumble of laws and regulations, and they're not effective if you don't have really good people properly incented to do the right things. And so, I mean, I think that the fault at Silicon Valley Bank, and probably Signature, I know less about it, the real fault was nobody was doing their job right. We didn't need any more laws to deal with that. We could have dealt with everything they were doing.
Mm-hmm.
There was nothing they were doing that we couldn't have stopped or improved. All we had to do was have some people on there properly motivated to tell them to do it. To see that they've tripled in size in 3 years. You don't need a bigger red flag than that. That's a huge red flag. That was, the FDIC used to have all these warning signals of the banks to look for and to start examining more carefully. I think the number one signal was rapid growth. You can't get much more rapid growth than growing from 60 billion to over $200 billion in 3 years. What were the regulators thinking? But I don't want to excuse the bank management, because clearly the bank management and its board of directors are making some very bad decisions, and they didn't have the proper risk controls and people in place to be playing in the arena they were playing in. It was an accident that had to happen. Now, I can't tell you what's going to happen going forward. I do know that the regulators are now supercharged, and they're going to be looking at everything very carefully. Maybe we fell sort of fat and lazy, and we were overconfident that we couldn't get in troubles like we were in the 80s again, because we learned something. Well, we didn't learn something. First Pennsylvania happened again. It called itself Silicon Valley Bank. So we can't take it for granted that we learn these lessons forever. We've got to be alert, and we've got to have our bank regulators, examiners on duty. Right now, a problem. I shouldn't say nobody. It's hard to find people when you go into a bank regulatory agency. It's hard to find any people there. Where are they? Well, they're working from home because of COVID. I don't see how that works.
Mm-hmm.
I don't think that's a good way to operate. I know that when I was running the FDIC, I was all over that agency, up and down the halls and everything, talking to people. I went to the cafeterias and ate with them, the people, because I wanted to know what's going on. I wanted to learn from them, and I wanted them to learn what I was seeing. I went to the training center at least weekly to talk to trainees coming in, the examiners. So I think it's a serious problem we have right now. Everybody wants to work from home. You cannot work from home as well as you can together in an office. And I'm not saying you can't take some days at home and work at home, but it can't be that way all the time. And that's what it is right now, not just at the FDIC, but at almost every government agency.
Yes.
You could shoot a cannon and not hit people. So that's one of the things that I'm concerned about. Let's get back to work.
Yeah.
And let's start paying attention to the fundamentals. You can't expect banks are always going to do the right thing. You've got to be watching them. The monitoring systems have to be really good, and you have to come by and visit them every now and again, because you can learn things by seeing and talking to people that you can't learn over an internet report. And so those are, I'm not really worried about being able to solve whatever problems we have. I really am not. I'm not answering your question now. I'll answer it. I'm not worried about it. I think we have the capacity, the people, the ability to take care of whatever problems are there. But I'm tired of this stuff happening again and again and again. Stop thinking about new regulations and models we want to do. Start being on top of the banks, and the banks start being on top of your business instead of expecting it's going to run by remote control.
Mm-hmm. Mm-hmm. No,
those are my thoughts.
No, absolutely. I wondered myself, as everything was unfolding a couple of weeks ago, how would you manage a crisis like that remotely? And I'm sure there's been, processes and policies and procedures written about that. But when it comes down to really executing it, I think it would be extremely difficult in the best case. I was very pleased. Literally 60 days, post the shutdown due to COVID, our staff was clamoring to get back in the office because we worked so collaboratively together. And I know that there are some of our IT team works remotely, and that's fine. But gosh, in this particular situation, it would be, I think, very difficult. And it'll be interesting to see how that changes, certainly in the coming months. maybe we'll see a change in that. You know, it's, I don't know, Mitchell, you know, kind of thinking back on the last crisis, would there be anything you would say from a resolution standpoint worked best during that crisis that might apply here if we had more bank failures?
You know, let me, Liz, I mean, it's a good question. But I do not think there's not much difference when a bank fails. The FDIC has to be there.
Mm-hmm.
And a lot of times, you know, failures can occur because of poor assets, you know, where charge-offs end up depleting capital. They can close because of fraud, or they can close similar to what went on today because of a lack of confidence that depositors are going to get their money. So they all want to show up and get their money. So we've always had bank failures that have closed. And we've always had primary regulators who have stepped in, and you know, and you have to do it under prompt corrective action, that step in and say, you know what, it's time for the FDIC as receiver to come in and protect the banks. So this was no different. The only thing that was different, I think, was the fact that the run itself was unbelievable. The amount of dollars that flowed out of there within 24 hours was just amazing. You know, the last big run I can remember was at Walmart, but that was like 10 billion, and I think it took 10 days for that.
Yes.
So, but I think what really is that we have to really keep our eye on the ball is the fact that if the FDIC usually, and our resolution and our receivership folks and our franchise folks have time to prepare.
Mm.
A lot of times in typical closings, which are the majority, the FDIC franchise marketing and our receivership staff and examiners are able to go into the institution, hopefully 90 days, 60 days, even 30 days, and start gathering intel. What are the liabilities? What are the assets? What are the operational issues? What are the things that we're going to put out there in market? So that by the time that the primary regulator, whether it's the state or the OCC, pulls the plug and says, receiver, here's the bank, the
Mm-hmm.
receiver then can immediately that night say, look, we've got another bank that's taking over. And so, you know, the confidence that keeps in the banking system is just tremendous. And regardless of how it failed. And what happened here in the last 2 weeks with these two failures, the FDIC staff did exactly what they have historically always done. When a primary regulator shuts it down, the FDIC was there. Now, granted, they scrambled. They didn't have all the data and all the information, but they still managed to create a deposit insurance national bank. And eventually they got it into the bridge where they were able to conduct these sales. And the FDIC utilized, you know, again, tools in their tool chest that we have learned historically and we've altered over time to try to get the best deal possible. Granted, we can talk about whether the uninsured should have been in there or all the deposits, but the folks that had to do the transaction took what they had. So they could have gone into what you call a basic P&A, where you know, the acquiring institution just assumes deposits and the good quality cash and cash equivalents. And then, you know, a lot of the remaining assets remain with the receivership. They could have done a whole bank P&A, where they basically take everything. You know, there may be some things left behind, like litigation and you know, different types of ORE and problem assets. The loss, they could have done a P&A with the loss share, where certain assets were guaranteed, or at least there were provisions in it. And we saw that they utilized that in both of these transactions. And then there could be a mix of both, a little mix of loss share, a little mix of passing assets of certain quality and certain things, and that's what they end up accomplishing. So I believe that the FDIC has managed this. You know, and if you can imagine, you know, for those on the, you know, the fact is, to do a merger acquisition in this country, an open bank merger acquisition takes months, if not years. And here the FDIC does it, you know, within a matter of a weekend. So I think people don't look at the fact that it stabilized not only the customers at that bank, maintained the franchise value of the banks, but allowed another good quality bank to come in and pick up the pieces. And now we're seeing the secondary effects, as you were bringing up. The receivers now are out there trying to sell. And, we heard of a major transaction, that they're going to try to move a lot of the assets out of Signature, with a contractor. So these are all positive signs that the receivership, even though they've sold to the operating banks, are now busy trying to minimize costs to the BIF. So getting back to your question, the fact is some things are the same, but things are better because the FDIC has a lot of people that are smart, and the history behind them and the tools they have are working.
Yes, they do. And Mitchell, I thought so much about this, back on my experience in working for the FDIC in the 80s and being on the closing team of about 40 different, institutions, banks, mainly small banks, actually, here in the southwestern part of the country. It's a major thing, to try to find an acquiring institution very quickly. And when you think about Silicon Valley Bank, I was listening to the questioning of Chairman Marty Gruenberg, and I was thinking about, they were saying, why didn't you find a buyer that weekend? And I thought, my gosh, I mean, just to think about even selling a $200 billion business in 48 hours, right? I mean, let alone the intricacies of a bank like that.
I think that's got to do with the history of the FDIC on Friday nights, always 99 or 98% of the time finding a buyer. So I think it's like they expect you to hit a home run every time, but they sure hit a triple. What they did. The other thing is the FDIC. And when I was there, we used to do strategic plans. We used to talk about how we're going to handle that resolution. How are we going to handle that receivership, and what could go wrong, and how are we going to have a plan B? And, one of the things I was very happy about, that when Dodd-Frank did come, there's good things and bad things in Dodd-Frank, if you talk the bill, but one of the positives is they codified our strategic planning thinking in the living wills.
Mm-hmm.
These are the things that you need to know in order to handle your own failure and to minimize costs to the taxpayer. So
and Mitchell, let me jump in there, because I don't have much good to say about Dodd-Frank, but that is a very good thing. The living wills are important. We didn't need Dodd-Frank to do that. The regulators could have done it without Dodd-Frank, or Dodd-Frank could have been limited to that, and the world would probably be a better place. But the living wills are very useful, because they require the regulators and the banks themselves to try to get their thoughts organized on what happens if we get in trouble. What are we going to do? And it depends on what the problems are. So you have to make some different scenarios and how severe they are and all that. So, but the planning on the living wills is so helpful to everybody, to the bankers, to the public, and to the regulators, and to the FDIC. Imagine trying to deal with, as I did, Continental Illinois, the fifth or sixth largest bank in the country. At the time. We'd never been in it, because the FDIC at that time was not going into national banks. We do now, because we changed that thanks to Continental and a few other things. The FDIC actually has a chance to go into those institutions whenever it wishes. But in any event, we'd never been in it. And we have the sixth largest bank in the country dumped on us immediately. They had a run. They lost half their deposit in a matter of days, and they were all big deposits all over the world.
Well, the other thing there, Bill, that was a correspondent bank, and they were providing correspondent services to 200-300 small community banks. So if that bank went, it would have dragged those other banks down.
Yeah, that bank was supporting 200 or 300 correspondent banks, smaller banks, as Mitchell was saying. And it was funded by large. They didn't have branching in Illinois, and so they didn't have branch banks. So they were funded wholesale banking by wholesale deposits all over the globe, and we were thrust into there with, a few days' notice. and we knew nothing about the bank until we went in. So the point Mitchell was making, and I just want to support it, is the FDIC is doing an incredible job. It's really, really difficult to go in and figure that out in a matter of days, or maybe even hours. And so, we had to think fast, and we had to start doing some things we'd never done before. For example, we let when we stabilized Continental by putting a large FDIC capital infusion in it, coupled with infusions that we talked a bunch of large banks into giving. So the banks and the FDIC both put large capital infusions together in there to stabilize it. Everybody thought that was strange, and it was, but we had to do something. We didn't have any time. We didn't know what was going on.
Mhm.
And so we did it. And Paul Volcker and I, and the Fed and the FDIC, and it's not just the two leaders, but the teams of these two wonderful agencies. They worked night and day, and literally night and day. I slept in my office much of the time. Didn't have time to go home. And so that's what you're dealing with. And so when people criticize these agencies for not doing well enough in a crisis,
Mhm.
well, just stop and think about it. Who could do that job
Yes.
better or faster, and with less disruption than the Fed and the FDIC? It's almost an impossible job. You can't do everything precisely the way you'd want to do it. Not even close.
Right.
But you have to get it done. You've got to take care of the public. You can't tolerate a bank run. And so you're really under the gun to get it done as best you can, as fast as you can. And you can't sit around thinking about things all day. And
Yeah.
I mean, it's really amazing. And I hope that people can have an appreciation for what's involved in the job that those two agencies do, the Fed and the FDIC, in crisis mode. I'm not talking about all the other things they do. There are people that don't like the way the FDIC regulates. Okay, that's up for debate. And there are people that don't like the way the Fed regulates. That's okay. Or they don't like monetary policy. That's okay. But when they're in crisis mode, those agencies are as good as there are in the world. And they knock themselves out. It's incredible how hard they work, night and day. They move at the drop of a bucket anywhere you tell them to move. I need you in California. I need you in New York. I need you in Oklahoma. And people go. So it's really we ought to be grateful that we have this kind of support system. And I wish we didn't have to use it so much. I wish we could get regulation of banking done better, so we didn't have to use these fire drills all the time.
You're right, though, Bill. I mean, I've witnessed that myself, whether it was when I was actually at the FDIC, during the banking, and then, the beginnings of the S&L crisis before I founded First Financial. And then during the last crisis, I mean, they're just immediately, and Mitchell would recognize so many of them, but, the largest agricultural bank failure that we assisted the FDIC with in terms of disposition. I remember back in early 2000s, Hamilton Bank, when it failed down in Miami and had trade finance credits all over Latin America and, 30 countries or so. And it's really stunning when you see the organization deploy and the area and levels of expertise of the FDIC staff taking care of so many functions, within an insolvent institution. It very much is, and most people would not appreciate that for sure.
Mm-hmm.
So we have just a few minutes left together today, and I would just like to ask each of you, for your parting thoughts. It could be on any subject. It could be on banking or whatever you would like it to be. So Mitchell, should we start with you?
Yeah, we've been talking about rising interest rates, but there's always other classes of assets that get affected, not just treasury bonds and what have you. But I'm very concerned about commercial real estate again. As Bill was saying, people staying home and working, a lot of businesses are rethinking when their leases roll over, whether they need as much space. There's a lot of businesses that, have decided, what, maybe we're going to go a different route. So I think there's a lot of developers and there's a lot of mortgages on commercial properties that I think, we're going to have to watch. And as we've seen from the last couple crises, large commercial real estate loans, they eat up a lot of capital when they go south. So I think that's going to be the next thing that could create some tension in the economy. And particularly if interest rates keep rising, who knows what's going to happen. So I think we got to keep the powder dry. I don't think we're completely out of this.
I agree with you. One of the things that has been of note within our organization over the last few years, we certainly have been known for working in, some very serious downturn economic times. But the truth of the matter is, over the last several years, our banking clients have been looking into their performing portfolios to see, which loans do they feel they would rather exit, redeploy capital, manage risk, when there's really not anything majorly wrong with those loans. And on the commercial real estate side, I agree with you. I think we're facing a number of potential issues. I mean, the situation with office and what we've seen in that, some of the pricing is certainly on the downward trend for those type of loans in major cities. And there's other issues for sure. So it'll be interesting to see how that unfolds. Bill, what would you say to our guests?
I get to wrap up this wonderful this wonderful celebration. I would urge people to don't forget who we are. We're a great country. We come from all over the globe, and we've got a whole lot going for us. I mean, there's never been a government, a form of government better than the one we have. And and we're bickering and fighting the way we did in the 60s and 70s again. And let's stop it. Let's start getting together and getting things done. And let's stop spending money we don't have. Let's be responsible with our funds. Get rid of programs in government we don't need, and take that money and put it into programs we do need. And stop wasting our precious money, and trust the private sector can do this job, this economic job that needs to be done, better than the government can. But we've got to have government leadership, proper leadership from good, solid agencies. The FDIC is one of them, but there's a lot of them that can help us obey the rules and go in the right direction at the right time, and not make dumb decisions, thoughtless decisions, reckless decisions. And so I really have enormous faith in this country. I really, really am proud of it. But we can do better. We can do a lot better than we are doing. And so let's all get behind whomever. I'm not going to make a political speech, but let's get behind competent people who will take us in the right direction and bring us together, and stop fighting about what we disagree about. I mean, it's just, life's too short. Let's get on with the good stuff that we all can do together. Those would be my pleas.
Oh, Bill, thank you. And Mitchell, both of you, I can't tell you how much it personally means to me to be able to host you this afternoon. I was obviously a very young woman when I worked at FDIC, and I looked up to both of you from way out here in Oklahoma City. And I very much appreciate, our friendship and our professional relationship. And I know that the audience has benefited greatly from your words today. So thank you very much. With that, I'm going to end the webcast for today.
Before you do, I want to apologize publicly for not recognizing you wherever it was when we first met.
Chinatown, New York, Golden Pacific Bank failure.
Okay,
We'll save that. That's another story, that bank failure.
forgive
That's
me.
for sure. No, you would have had no need to remember. You were meeting an awful lot of people in a very short period of time. Thank
Thank
you both, and I wish all of you a great afternoon, and thank you for joining us today. Bye
Thank
now.
you. Bye.